afternoon and welcome to BizTech's Asian Midday Market Watch. It's Wednesday, the 27th of September, and we have Kian, CEO of Astral Asset Management, as our guest today, coming to us out of Singapore. Now, Kian, it's always great to have you on the show.
Good afternoon.
Now, Kian, for a start, and I want to bring you back to some of your predictions from the past. Now, the recent Fed meeting really kind of reaffirmed your position, which you have mentioned before in previous shows, that your expectation is that interest rates will remain elevated. Now, the Fed alludes to that. And what's really scary for me is the fact that Jamie Dimon has just come out, the CEO of JP Morgan, and he thinks that a 7% Fed fund rate is still possible. Walk us through your thoughts and what you think of Jamie Dimon's statement as well.
I think for the last past 18 months, we see interest rates hike, significantly. And in a very fairly quick time, within a 18 months period, we see interest rates hike of 11 times. And the expectations of the market is, finally, the Fed should take a pause. And if you are one of those who borrows money, from the bank, you would say, look, the interest rates now is fairly significantly high, and you wish that this interest rate will at least tapers, and if not, starts dropping next year. I think that was the forecast that the market has prior to the last Fed meeting, that there's going to be a 4 times decline in interest rates in the coming year, 2024. But I think in the last meeting, that whole scenario has changed, because Fed Jerome Powell has reaffirmed that he's going to keep interest rate high as long as inflation is not tame. And we are looking at current inflation of 4 to 5%. And even for him, that's not good enough, as the US Central Bank has a long-term target for inflation at 2%. What he literally means is there could be more interest rate hikes, as well as if the inflation numbers don't come down fast enough, you at least keeps interest rate at the current levels. And the market was a bit surprised, because they were hoping that there will be 4 times interest rate cut next year, and straight away that expectations is readjusted to just 2 times. And then the recent article actually really changes the landscape, because the hypothesis of about 5 increasing from 5% to 7% is really quite shocking to many people to even hear about this, because the incremental pain from 3 to 5% versus 5 to 7% is very different. And imagine if you are a business, and you have to deal with a 7% interest rates, plus the interest that you have to pay to the banks, it's going to be very significant. And a lot of business potentially could not operate if they need a bank loan. Similarly, it's going to hit the home loan owners. The homeowners who needs to take up a home loan, the interest rate will be much significantly higher than the current situation, which points to an economic slowdown.
Now, the other canary in the coal mine in terms of the coming economic slowdown in the US, despite the robust numbers today, is the fact that consumer spending, the last pillar really from the pandemic, all that savings is basically being exhausted. And there are signs that basically the consumer is running out of cash to spend.
We read a couple of reports, right? And we knew that the key pillars of the US economic growth this year is predominantly COVID recovery, and as well as strong consumption spending that we have seen so far. And that was a result of, huge amount of savings that was garnered by the US consumers during the COVID years. We see a lot of revenge spending. And I think we are starting to see reports from various sources saying that, hey, that savings might potentially come to, an end as they are depleted. And there are concerns, because we need to know that US is an economy that's driven significantly by the consumers. And if the consumers stop spending, it is always a huge concern, pointing towards economic slowdown.
Now, Kian, I want to bring us closer to home now. Now, digesting all the information that we just shared over the last couple of minutes, we have to then present the numbers in Singapore for industrial production yesterday, which were quite shockingly bad. What's your take on that, and how the regional economies are going to be impacted by the slowing US economy and, of course, the greater global economy?
Singapore is a trading hub, so if there's a global slowdown by United States as well as China, the export numbers are never going to look fantastic, and we have been seeing a decline in the past months. Never surprising, and I think analysts and the market is watching to see if the decline remains as significant, or is there a narrowing of the drop. And so far, I think the decline continues. It is a concern, and which also points to a slowdown for the economy, especially in Singapore. Same for South Korea. Countries or cities that are very dependent on exports and imports business. We've seen that Singapore economy is slowed down to less than 1%, and I'm hoping that we could stay above recession line.
So now, wearing the investor hat now,
I think investors are very concerned. Yeah. And and as a result of waiting for and being worried about a recession, investors are now taking money off the equities market. And given that if they put their money in short-term treasury bills or fixed deposits for short-term, they are garnering around 5% or to 6% for US dollars. I think a lot of investors have chose to stay in the sideline and putting their investments, their spare cash to all the money markets investments and see what the situation and how the situation will unfold.
Kian, as always, thank you very much for your insights. Thanks for coming on the show.
You're most welcome.
Now, we've been speaking to Lee Kian Soon, CEO of Astral Asset Management out of Singapore, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out this interview on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.